All right, so the Fed cut the interest rate 25 basis points. That's what we were expecting, but that's not the story. What is the story is what Powell was saying in the presser after and how the markets reacted. What happened was, they cut 25 basis points, and in the summary of economic projections, the SEP, they predicted 3 more cuts by the Fed is predicting this, giving forward guidance of 3 more cuts by the end of the year. And the markets had only priced in 2.25. So this is bullish. And when they came out, bond yields dropped, stocks bounced, but then Powell stepped out into the mic and then basically admitted we've got a labor market issue and it's worse than anyone thought. And that's where it got interesting. So the summary of economic projections, like I was saying earlier, came out. It said everything looks fine. Before he talked, that's where, bond yields dropped, that's where mortgage rates are tied to 10-year treasury yield. It's spread on that. And so the 10-year treasury came down in yield below 4%, based off of the SEP, the Summary of Economic Projections, because it had more rate cuts by the end of the year, unemployment to stay in the mid-4s, and growth ticking up, and inflation not being a major issue. But Powell, when he came out, he said we're below break-even rate for hiring and that the labor demand is weakening. If labor force participation increases or layoffs pick up even slightly, unemployment could move up to 5% pretty quickly, and then you're a little bit more looking down the barrel of a recession, right? And then everyone at the Fed would be wrong. But he also literally said, this suggests, and I'm quoting him, this suggests labor market is really cooling and it's time that we take that into account. Yet all we got was 25 basis points. I mean, that statement right there doesn't really add up. And Powell also said something that I have personally been yelling for 9 months. I've said this to a lot of people. With tight monetary policy and spending pulling back, most companies don't have the pricing power to stick the tariffs and inflation on the consumer. They're going to take it in margin, and this isn't new for me, but this is what the Fed is actually catching up, and Powell said during the presser. I couldn't believe it. I was like, I've been saying this for 9 months. Like, these tariffs, like, the companies don't have pricing power to move that increase onto the consumers. So they're going to take it in the margin, and then they're going to, have less profits, and then probably fire people. So we don't have inflation like we thought we were going to from tariffs, is basically what he said. With inflation not being much of a problem, it's a dual mandate that the Fed has. It's stable prices and maximum employment. And so if we're not really worried about inflation much anymore, then let's get ahead of the job market. We're also waiting on the Supreme Court to rule whether the tariffs are even legal or not. Our oral arguments are September 5th, and then, it'd be months after that for the Supreme Court, I think, to give a judgment on that. But that's not my strong suit. But either way, we're months away from that being even yes or no. And if they get thrown out, then even more deflation. We got to cut more. So what happened after the meeting? At first, like I was saying, the 10-year treasury dropped under 4%, and that's what mortgage rates are attached to, the yield of the bond market and the 10-year treasury specifically. So I was like, oh yes, okay, we're getting lower interest rates for mortgages. This is great. Looked like a green light for mortgage rates. But then once the presser came, then the bond yields started moving back up to where they were before. And because the bond market is calling BS. The Fed's saying one thing, but then Powell's tone was something different. It was neutral, at best. But markets are basically saying you're cutting too slow, with bond yields not dropping in lockstep with the overnight lending rate, which is what they cut. We've got another round of data coming first week of October for jobs, and that will confirm or not what Powell hinted at relative to the job market. And we might see the Fed open to signaling for more cuts then, or even quantitative easing, printing money down the line. Now, 3 cuts this year is a solid start. That is stronger than we thought. We're just a little scared of what Powell said about the job markets is really what the bond market is saying. But now, and that's just based on his tone, which who knows, that could have been politically motivated, like cutting rates, but then he's like, I don't want to sound like we should have cut rates because his feud with the president, you know what I mean? So he could just be, his tone could have reflected that. Who knows? But either way, the data is coming in to back up a rate cut. It's not all political like a lot of people think. There's like these conspiracies, you know what I mean? It's just like, it's time to cut. And even the bond market thinks we should be cutting more, faster. But private market always will probably want to do that. But anyways, 3 cuts is a solid start for the year, but I wouldn't be surprised if they did move faster. This is great news for real estate, maybe not in the short term for the next month, but we could finally see mortgage rates start coming down by the end of the year and going into next year. And hopefully we get that shift before the job market actually turns. So for buyers and sellers, could this open up a window? Absolutely. Opportunity heading into the end of the year, especially if you've got cash. Now could be a great time to lock in a deal before rates drop and more buyers flood back into the market, right? And so at the end of the day, if you're a real estate investor, time in the market beats timing in the market every time. You've got a long-term view, find the deals that make sense, structure it right, and go for it. Personally, I think dollar cost averaging, basically buying an investment property every other year or whatever your time cycle is, just like consistently, trying to develop your portfolio rather than trying to time the market here and there. And then you're waiting forever, and then it's like opportunity cost, you're just sitting out for too long. Real investors buy through cycles, and you just got to let that time work for you. And if you're buying a primary house, focus on the product, right? There is something called forced appreciation. You can get a good deal in a market and put a little sweat equity into it, and then you can't do that with stocks. Like, you're buying at market rate. Like, there's no getting deals on stocks unless you see fundamentals, but you're still buying that day the same price as everyone else, right? With real estate, you can get a good deal. It can be a one-off thing. And if the house works for you, then great. So there's deals in every market. So really just focus on the product that you're trying to buy. And, historically, prices go up. And we're entering into a new cycle, a monetary easing cycle, rate cuts. And historically, rate cuts are great for real estate. And so if you're trying to plan your next real estate move, buying, selling, want to talk to me, I love helping out with clients. I actually just got a message from a client I need to get back to right now because we're putting in an offer on a great deal. They're out there. So give me a call, 801-837-4445, and I would love to help you guys out. And see you guys next for the next update. And hopefully racing goes good this weekend. I'll let you know.